Okay, let's talk about Opendoor because that's what anyone's talking about right now. But I think it's very important to understand what the company even does, because if you don't know what a company does, then how can you put money in it? So let me show you how to find out what they do. Go to sec.gov. This is where all the financial filings are, and you can just type in their ticker, Opendoor, and then you can look at their 10K, which usually discloses what they do. So if you look at the filing here, this first one here is usually going to be it. If you scroll down to page 6, they'll talk about their business model and what they do. And essentially, there are a few segments. The users will sell their house to Opendoor, and then they'll basically flip the houses. The other two segments are that they'll list on Opendoor, and there's an Opendoor marketplace. These are what's called asset light business segments. And from looking at competitors, because they never disclose this, if you look at OfferPad and a bunch of other ones, this would roughly be around 3% of the revenue or less. Because if you look at how many houses they sell and the median price of the houses they sell against their revenue, you'll find that basically 0% is going to be revenue from this asset light. But before we go on looking at the actual model, okay, so let's take a look at this Reddit post that launched 1 million shares. And he says, I know 99% of you idiots won't read this, and I'm going to be an idiot here because I'm just going to skim through this and highlight the interesting parts. But mostly this is just going to be fluff, in my opinion. The stock dropped 98%, but it's far from bankrupt. Okay, but this is kind of just fluff, because just because the stock dropped 98% doesn't mean that there's any precedence for it to go up 50x back to the original price. It made $1 billion flipping houses in 2021. If we actually look at 2021, we'll see the net income is actually negative 674, but their gross profit is going to be about $1 billion, 730 million. Anyway, this kind of talks about some fluff. They used to light money on fire and not as much anymore. But even when you look at the financial statements, it's not really about burning money or not. The business model just loses money, and they can't stop it from losing money. And basically, in conclusion, Opendoor is a dumb company that made $1 billion in 2021 when the housing market was good, and then they overspent. They fired him, and then they hired a new CFO. Now they're cutting costs and they're learning important lessons. The Reddit post asserts that they can make 100x on the stock, but no one here does it give a valuation of why these savings will make it 100x, nor do they really quantify how much they'll save with the new strategies. Now, of course, do I wish that I bought at 70 cents? Yes. Okay, so let's review the plan of what they're going to do to turn this company around. So it kind of relies on 3 things. The first kind of hidden thing in the Reddit post is like that the Fed rates will go down and then the housing market will appreciate. But it doesn't take more than 2 brain cells to rub together that if your business is dependent on Fed rates going down for you to be profitable, then there's going to be very bad seasons for your company when Fed rates go back up, which they eventually do. So you kind of have to flatten out that curve and then kind of say, well, what's the average? So I don't think it's a long-term factor and a short-term factor and kind of like a momentum swing trade. You can take a look at it, but for a value investing perspective, it doesn't really make any sense. And the second thing that they want to do is to cut costs. And one of the things that they want to do is cut their 1,700 or 1,400 employees to 1,400 employees to 200 employees. Okay, we'll take a look at that later and what that actually means, how much they'll actually save. And then the third thing that they want to do is to increase volume. Here, the new CEO from Shopify, COO from Shopify was hired, and then they're kind of now talking about opening Opendoor everywhere, and they're only available in about 15 markets right now. We'll actually look at what this might look like in terms of revenue increase as well. And one comment I want to make on this is from this transcript. In this transcript, they were talking about how they were able to make a 3% gain in 36 months per house. Then that's after the holding and property taxes and carrying costs, which are very expensive if you've flipped houses, and rehab costs So 3% gain 36 months is quite incredible. It really is reflective of back in those times in 2021, where the market was recovering and kind of skyrocketing and outpacing all these very, very expensive things. But a 3% gain is actually quite atrocious if you think about it. At volume, it's quite good, but if you were an individual investor, for example, for me, anecdotally, I bought a few houses in Tennessee, Memphis, in 2016, and I sold one in 2018 for a 50% gain, another one for 100% plus gain in 2020. And the reason I was able to get such alpha on it is because I did a lot of research and I was very selective of what homes I buy, right? If they weren't very well below market, I'm not going to buy it. And if they weren't very well conditioned, I'm not going to buy it. And my kind of USP for the home sellers is that I can provide them cash quickly, which was kind of a lie because I use Wells Fargo and Wells Fargo will never close on time, so don't use them. Anyways, 3% is atrocious considering you can do a lot better as an individual investor, but they're going for volume, so 3% is actually not that bad. But this kind of just sort of illustrates the more volume you do, the lower quality of your investments are going to be. Now, they're going to expand their volume by a lot by opening in all lower 48 states in the US. So you can kind of impute that their profit per property is going to go down no matter really what they do with real estate agents. As long as they buy the asset from a customer, even if you don't rehab it, there is some sort of market risk associated with it. That's just kind of nature of buying houses and the nature of the business model, and I don't think this post reflects or understands that at all. There's just kind of a lot of variability when you buy houses, and I can't really emphasize that enough as sort of the crux of why this might not be as good as you think. Let's take a look at the model now and give them the most benefit of the doubt. All right, so let's take a look at the gross margin first, because the gross margin is reflective of the business. The gross margin isn't something that changes, right? So if your business model operates one way, your gross margin is going to stay the same. And if you change it, you can increase it, decrease it, whatever. But all things considered, you can cut costs in your employees and sales and marketing, things like that. The gross margin won't change. The gross margin is just basically for the houses they get, how much profit do they get? And a lot of it is just going to be about 8 to 13%. And we're going to make some assumptions here and then give them the benefit of the doubt as they kind of turn around the business. But that's just the range that I want you to keep in mind, 8 to 13%. And then let's now look at their maximum revenue potential. And if you look on their site, their service cities are these cities. And I went ahead and did the work of taking the population in all of these cities. And if they were to expand across the entire US, and you do the division, which is about 350 million, divided by 65 million in the people that they serve already, they have a potential to 5.3x their market. And kind of maybe a very rough and not so accurate estimation, you can say, well, that's 5.38x of their revenue. If we take that number over here and then multiply it by the 2024 revenue, then this is the 27 billion revenue that we have as a peak revenue if they actually saturate all 48 states and they're making money. The reason why I didn't do it for 2025 is because they're projecting a lower revenue for Q3 and probably therefore a lower revenue for Q4. Just to be more optimistic, we're going to clamp it to this higher year and then we're going to multiply it by the population proportion. Okay, the next thing, now let's take a look at their cost-cutting measures. They mentioned that they want to cut 85% of their workforce, so this G&A will go down by a lot, 85%. So this is what I did here. I kind of assume that it'll take around a year or two to kind of slowly ramp down. You can do it quicker if you want, but if you just look at the revenue, which is about $1 billion, and how much they actually spend on G&A, which is on the order of 30 million, you're going to quickly find that they could cut it to zero. It doesn't really matter that much. I'm kind of suspicious though, because if you're going to ramp up in volume, there's going to be a lot more exchanges, a lot more agents to deal with, a lot more problems that come up. So I just don't see how you can cut 85% of the workforce while having a lot more work per employee. But we'll take it at face value on these kind of sanguine marketing statements that's made by their team. So now we're down at 4 million from 28 million. So we save about 20 million, which isn't bad. It's not bad, except that their per quarter net income is, anywhere from minus 29 million to minus 106 million at its worst, right? So this is maybe a $20 million boost per quarter. And so good, but it's not really the panacea for everything. All right, so now that we've looked at the maximum potential revenue as well as the cost cutting, let's take a look at how all this comes together. All right, so we got this 27 billion, which I kind of just said, well, this kind of looks like, if they keep ramping up, eventually maybe in 2032, they'll hit this 27 billion number for revenue, while growing their gross margin eventually to 13%, which is their peak gross margin. All right. And this is insane, kind of an insane growth for the entire company. So discount rate's a little bit higher. I think at some point, if you do this sort of extreme expansion year over year, then you kind of need to hire some people back. And being very conservative here, I'm like, well, we've cut 75% of our workforce amortized over the course of 2025, 2026. We're going to need to hire some people back to kind of support this massive expansion. And sales and marketing is really going to be directly proportional, I think, in this kind of a business to how much revenue they make. So that's going to be what it's based off of. But these are kind of just numbers that are touchy-feely. The key point here is that we eventually reach this peak of 27 billion while we expand our margins, right? And then if we kind of go that route with this discount rate, we see that's worth about $2. Let's take a look at what is worth $10 right now. Also, this is going to be like an 80% drop here, right? And this is with the assumption that they're going to do very well and turn the business around and expand the gross margin, and they're going to cut costs, gonna 8x their revenue from 2025 while expanding margin, while cutting costs. They're still 80% below the current price, which is kind of insane that it's priced right now the way it is. But I think one thing that's very interesting is that it'll kind of come down to this gross margin number. And I think they're going to try to do some business changes to be able to increase it. But I initially thought that they might, if you take a look at this tab, that these asset light segments of the business will eventually take over the whole business. And in that case, their gross margin will go up and they'll be very profitable. The problem with that thinking, once I thought about it some more, is that the market for these asset lights might not be as big, right? Because if they could do it, they would have already done it. So I think for them, in terms of volume and absolute dollars that they can earn, is really buying houses and flipping them. Because as long as you're sticking to the model, there's some limit to how much you can increase your gross margin, right? You can, partner up with agents and things like that and, increase your gross margin. But I mean, in the heyday where the market was an enormous tailwind for them, they were still only doing 13% gross margin, and they were selling a ton of houses. And not only were they selling a ton of houses, but even then, while they're selling a ton of houses, they were losing money. So assume that, now they're selling a ton of houses as the business kind of converges to a stable state. They're making about $60 million a year only. $60 million a year business is going to be worth $7 billion, right? That's wild, right? I kind of want to touch on this gross margin again, because if we say, well, let's call the gross margin 20%, right? Which would be a fundamental change in how the business is done, then yeah, this is quite unbelievable, first of all, but it will bring it to $12, right? It's currently at $10, and so your upside is really only 30%. But they would really need to change how buying and selling houses work. So because of that kind of inherent risk, where some houses you'll make money from and some houses you just lose money from just because it's kind of a bad house, especially when you increase the volume of houses you purchase, I don't really think the gross margin is going to beat what they had in 2021, where they were able to kind of make 3% per house in 3 to 6 months very quickly. So let's take a look at the summary of this thesis, and I think what you should do here, right? So what is Opendoor? They buy and flip houses, and the numbers assumption is that the asset light is less than 3%, and I don't think that will take over the business just because of the market sizing of it. And even if they could convert the entire business to an asset light business, isn't it more expensive to tear down your existing business and start a new business, as opposed to if, let's say, you just started a brand new company from scratch, raised, and then just did the asset light part of the business, right? It doesn't make any sense to me that they would convert the whole business to asset light. The margin is 8 to 13%, but here like 10 to 13%. But the thinking is that it's not going to be your 80% that you see in like a lot of software things like Shopify, right? They have a rockstar CEO from Shopify, and there's a meme rally going on, and they want to cut from basically 85% reduction. That's what they said. Now, the bear case is that the scaling that they want to do to grab more revenue and more markets doesn't fundamentally solve the business issue, which is that the business model doesn't work. For the business model to work, to get consistent gain per house that you flip, you really need to do a lot of research per house, and they're not going to do that. They have some crazy AI algorithms to do it, but that's just generally not going to be the case. It's not going to be as easy as using quantitative strategies for the stock market, because there's a lot of things that you don't see in a house, right? Like you can take a look at pictures, but the pictures don't really reflect the reality, right? The pictures might look pristine, but it might smell like sewage, right? The house might look very nice in the pictures, but it has bad bones. So you need to do a giant rehab before you can sell it. I know people that have bought $1.2 million houses to flip in the Bay Area for $800K, but then they lost $500K because they just had to redo way too many things. The rehab took much longer. The hard money kind of kicks in terms of eating out the profits and everything like that. Variability is a real issue here in terms of like every unit of house that you get, and I don't think that they can really solve it by increasing volume. If anything, if they want to make more money per house, they have to decrease volume so they can focus more effort per house. And then the next thing in the bear case is that the CEO is from Shopify as a COO. And there's a lot of strategies and things that you can do in software that might not carry over to a very hard asset sort of a business, like that variability and that risk. In software, there's not really that kind of a thing there, right? Software, you acquire your customer and you do your best for your product to keep your customer. If you look at his Twitter profile, he asks product questions and is trying to hire people that are trying to make the product better, but that's not the issue that'll save the company. The business isn't not profitable because the product isn't that good. If the product is that good, they'll increase the number of deals that they do, but they won't increase the deal quality, right? In fact, it'll worsen the deal quality per house. So 30% gross margin will probably be a pipe dream. But I think it will be actually lower, but in my model, even with the 13%, it's 80% lower than the current price. Even very optimistically, it's probably worth like $2-3, right? So I think here, he's asking kind of the wrong questions for Opendoor's business model. Is obviously always better to have a better product, but it's going to be way more beneficial for a company like Shopify and SaaS, and sort of irrelevant to Opendoor. The Opendoor, you really want your deal per house to be a lot better. That's kind of how you're going to gain. And a bad business model is a bad business model, right? And I think the business model is bad, and the only way they can change this is to do a brand new business model. But if you can do a brand new business model, why not just not use Opendoor and just have a completely different company, right? Give this completely different business model. And the next thing is that it's cyclical, right? The Fed rates is going to go down, and then the Wall Street bet folks are like, well, it's going to be extremely profitable forever. But the thing is, Fed rates are cyclical, so if you're buying Opendoor for the real estate appreciation, why wouldn't you just invest in a REIT then, right? So, a REIT is going to just be a lot more simple business model without the extra software overhead and complexity. So why wouldn't you just invest in a REIT? And that's kind of like tongue-in-cheek because REITs underperform SPY. So I just don't think this is a very good stock. Now, am I saying short it? No. And this is the reason why. After all this, in this super long video, I don't think you should short this Opendoor stock. And I think this is the reason why, right? Just like GameStop, there's a bunch of zealots, and the zealots can kind of keep the price propped up almost indefinitely, right? So this is really not a game of value investing, even though everything I said before is value investing. This is really a game of riding the hype. There's no marginal traders. People just want to hold on for years and years, and there's no sellers. Then shorting doesn't make sense, because shorting, usually you need some sort of erosion over time or some catalyst to kill it, right? So if you short right now, for example, who's to say it won't bubble up and go to 100, even though it's worth $2, right? In the .com bubble, we've certainly seen things that are supposed to be worth like 2 pennies be like $500 or something like that, right? So there's not really a great way for you to time the short. So I think for things like this, I probably just close the door on Opendoor.